We're here at what I think, and you must think too, is a turning point in history. There's two great events taking place right now. One of them, as you know, is an election in the United States, a presidential election, which at least in the last few days has dominated the news. But the bigger story, what's really dominated the news, the bigger event going on is the great financial crisis. And I have a book coming out on the great financial crisis that will be published in January, and this is the cover to the book. And you can see J.P. Morgan there blowing bubbles. I think a lot of you have heard about bubbles lately, financial bubbles and the bursting of financial bubbles. And this is really the big news event, not only in the United States, but in the entire world. We have the greatest financial crisis since the Great Depression, and probably the greatest economic crisis since the Great Depression as well. It's mounting so fast, it's so serious that we're running into issues that we haven't seen for 80 years. And I think that it will, in one way or another, transform all our lives. We don't know how far this crisis is going to be, how far it's going to go, but we know that it's going to be very serious, and I want to try to explain the reasons why. But just on the bubbles, on blowing bubbles, if you get a chance, try to find on the internet a piece on blowing bubbles and financial crisis that appeared in The Onion, the satirical magazine The Onion, which I think had a better analysis than just about all of the economists out there. And the Onion said that the bubbles were the only thing keeping the U.S. economy afloat. And of course, the bubbles have now burst. When we talk about, I mean, it's a tradition in economic analysis to talk about financial bubbles. Financial bubbles traditionally occurred at the peak of the boom in the business cycle, and were relatively insignificant. Oh, they're dramatic events, but not all that important. But we're living in a time where the bubbles have gotten bigger and occur not simply at the peak of the business cycle, but are a more general phenomenon, and I want to explain that to you. But the last two bubbles, so you understand this, is we talk about the stock market bubble in the late 1990s. You heard, of course, in the latest election campaign, how much better the Democrats did than the Republicans with the economy. And you shouldn't believe it entirely. What the Democrats benefited under Clinton benefited with what is called the dot-com bubble, or the new economy bubble that burst in the summer of 2000. And that stock market crash resulted in the recession of 2001. And the reason the recession was so mild, the reason that we got off fairly easily, was that there was what they call a great bubble transfer. They lowered the interest rate drastically. The Federal Reserve Board lowered the interest rate in 12 successive cuts, and got it down to 1% or so, and kept it there. And that fed another bubble, the housing bubble, which created a speculative mania that began to unwind around 2005. Well, it peaked in 2005. The bubble was pricked in 2006, and in 2007 it burst. We had a major crisis. In July 2007, you had two Bear Stearns hedge funds collapse, which would not have been that significant of an event. But they had all of these mortgage mortgage-backed securities. And as the hedge funds collapsed, they had to revalue these collateral debt obligations. I won't go into what these are, but these mortgage-backed securities, and they found that they couldn't value them. In other words, their value was not anything like what their nominal value was. And suddenly the whole financial community panicked that they had been creating these securities based on mortgage loans. And the whole thing turned out to be somewhat of an illusion. And anyway, I will try to give you the general story on that. But I want to start with the bailout. Most of you probably really became aware of the severity of the crisis on September 18th or September 19th, 2008, when on September 18th in the evening, Ben Bernanke, the chairman of the Federal Reserve Board, and Henry Paulson, the Secretary of the Treasury, went to Congress and told Congress that if they didn't, they told them that the U.S. economy, the financial sector, was within a few days of a complete meltdown, and if they didn't support a $700 billion bailout for the financial sector through the Treasury, that the whole system would collapse. And then the next day, of course, that became a public issue. Henry Paulson made the public announcement, and it created a big debate in the United States. A very serious, there was a very serious public revolt against the bailout, and the House of Representatives actually voted it down, as you know. But in a few days, they managed to ram it through anyway by convincing certain representatives to change their votes, and the bailout package went through. But for most of you, that's when it really became a big issue. It was in September 2008 that you had the collapse of Lehman Brothers and the really big banking crisis. But you have to understand that the crisis itself began in July 2007. So it had been going on for more than a year before most of you probably knew how big it was. And they had been bailing out the financial sector all this time. And it's very important to understand this. You've all heard about the $700 billion bailout. What you probably don't know, or many of you don't know, is that at this point in time, the U.S. Government, through its bailouts of Freddie Mac and Fannie Mae, of Bear Stearns, of AIG, and its bailout package, and its support of the commercial paper market, and so on and so on. The U.S. government has so far committed over $5 trillion to directly bailing out or providing a backstop to financial operations. For example, in the commercial paper market, the Federal Reserve has said that they will buy the commercial paper to up to $1 trillion to make sure that there's a market for commercial paper, which is the short-term debt issued by corporations from which they, for their daily functions. And altogether, over $5 trillion has been committed by the U.S. government itself so far, which is over a third of annual GDP. You've probably only really heard about the $700 billion part of it. The first rule of central banking is that when there's a financial crisis, you bail like hell. And they've been bailing like hell for about 15 months now, and they've been failing. And it's important, and the crisis has spread globally. and now it's become an economic recession. Perhaps it will be a depression. That's the great fear, and we'll talk about that. But the every part of the world is now in a state of economic crisis. Europe's in recession. The United States is in recession. The whole world economy is in recession. The emerging economies are in trouble, and so on. And so far they have not been able to stabilize the situation. Okay, what exactly is going on? Well, one thing is their first response, and I'll try to explain why, when they were confronted with this crisis, was to do what they're supposed to do. I'm talking about the Federal Reserve Board, the Treasury, the government, and so on. What they're supposed to do is, if there is a credit crunch, if there is a financial crisis, they're supposed to pour liquidity into the system. And they do this by lowering interest rates. They do this by various kinds of operations they have. I won't go into all the elements of it, by which they pour, they try to increase the amount of cash in the system. They try to make it possible to shift the whole system to financial claims that are easily transferable, such as cash. You can see it in simple terms. It's more complex, as if they're pouring money into the system. In fact, and there's a whole history of this. It's called the lender of last resort function of the government. It exists in all of the governments. All the capitalist economies understand that the government, particularly in the major economies, has the role of lender of last resort in a crisis. So their response is to pour money into the system, to liquidify the system, to get lending going, to get the financial system going up again. And this goes back to the Great Depression, and it also operates on a certain kind of economic theory that's prevalent, that's prevailed over, let's say, the last 30 or so years. It started with monetarism, which a very conservative economic philosophy that focuses on the supply of money as the key factor in regulating the economy, you've all heard of Milton Friedman. Supply-side economics, also called Reaganomics, and various theories of this sort, emerged in the 1970s as the dominant perspective overthrowing Keynesianism that had existed beforehand. And they reinterpreted what had happened in the Great Depression 80 years ago now. They looked back at the Great Depression and they said the reason for the crisis was simply that the federal government did not open up the monetary floodgates at the right time. They didn't lower interest rates. They didn't pour liquidity into the financial system. So it was simply a problem of doing that, to making sure that the money supply was big enough that there was liquidity in the system. So at the first sign of trouble, Federal Reserve Board, the central banks, always try to pour in liquidity to get the crisis, to stop the crisis. And that's what they tried to do, except that it didn't work. It hasn't worked. I mean, I just gave you the figure of $5 trillion the U.S. government has committed so far, and it really hasn't stopped the problem. The problem keeps getting worse. And of course, all the other governments have committed liquidity too. The problem is that there are more fundamental difficulties involved here. The whole financial speculation, this particular bubble, was built on the backs of mortgages, and there's an insolvency, and the insolvency goes all the way down. So the banks ended up being insolvent, not just short of funds, not just unable to lend, but really lacking capital. normally they lend, they call it leveraging. Let's say in the big investment banks, they were lending $30, $35 for every dollar of capital they had. Now that's all coming back on them in reverse, and their capital disappeared. So it was an insolvency problem for the banks, but it's insolvency all the way down in a sense, because the problem lies ultimately in the households, in the fact that people are going bankrupt at the bottom of the economy, and these were the assets of the banks, right? And the whole financial structure was so leveraged to such a degree. And they thought that they had created a risk-free situation where a risk-free structure where they could go on and on, leveraging the economy at higher and higher levels, and there wouldn't be a problem. Well, that's all proven to be wrong. Let me just give you, I want to move a little bit in the direction of an historical account and of this. And just in terms of the Great Depression, the theorizing went like this. They used the term "it" for the Great Depression. And Hyman Minsky, one of the great economists of modern times, actually the theorist of the financial, the developer of the financial instability hypothesis, which, or financial instability theory, which most orthodox economists ignored, wrote a book once in the 1980s called "Can It Happen Again?" meaning the Great Depression, and he said yes, it could. The problem, because the system moves towards higher levels of financial instability. It goes from a robust financial structure to a fragile financial structure, and every time the government intervenes to prop this financial fragility up, to prop the system, I'll deal with questions afterwards. Every time it does, it makes the whole system more precarious than before. The government comes in as the lender of last resort, and if they succeed, as they did to some extent as they did in 1987 or 2000, they actually create a situation that's worse down the road, and eventually the problem becomes too big. The lender of last resort can't even really handle it. The government is hardly big enough to handle the size of financial claims that are out there. For example, when Lehman Brothers collapsed, the credit default swaps involved were hundreds of billions of dollars, and from one bank alone. So the economists always talk about it, and Ben Bernanke, who's currently the chairman of the Federal Reserve Board, was the point man in the Federal Reserve to figure out what to do in the case of a major financial crisis threatening depression-like conditions. And he argued he's a monetarist. He's a follower of Milton Friedman, and he said, well, really, Friedman was right. We just need to pour liquidity in. We need to put money into the system to save the banks, and that's all we really need to do. That's the main thing. So he said we could have helicopter drops of money, and we could get the printing press going and get the government to print more money. And essentially they've been doing these things and it hasn't worked. He said that if we do this, it won't happen. Well, now that's been proven wrong. What they're facing is the greatest fear in the modern economy is of a debt deflation. A major debt deflation in the United States has not occurred since the 1930s, and probably most of you can't even imagine what it is. The most recent example in the modern economy is Japan, which had a financial crisis, a crash of the real estate and the stock market in the late 1980s, and then they had a decade of stagnation with a debt deflation. Basically, deflation is when prices go down rather than up. And so you have falling prices all your lives. In fact, the entire 20th century, except for the Great Depression, we've seen nothing but rising prices on average for the whole economy. Now we're talking about the possibility globally, in the United States and globally, of falling prices. You already see that in the housing market. And that means that a whole lot of processes that leveraged all of this up go into reverse. And the debt, every dollar of debt you owe gets bigger. The prices of your assets goes down, and the value of the dollars of debt that you owe increase, since each dollar is worth more over time, as opposed to an inflationary situation where dollars decrease in value. I can't go into all of this, but it creates a kind of downward vicious cycle that is very difficult for a capitalist economy to deal with, and it leaves the economy stuck in a kind of stagnant position, and this is what the fear is. And so this is where we're at. This is what we're worried about, and I want to try to explain why this happened at a deeper level, because you can talk all you want about the financial instruments and the financial economy, but the real answers lie in what the economists call the real economy. They sometimes think of the financial economy and real economy as totally separate from each other. Financial economy deals with asset prices, like the price of houses or the price of stocks, and those are priced separately than the price of output. And what is called the real economy is the whole income sector of the economy, what most of us live within, unless we're speculating on assets. We basically live around income. Production is the basis of the real economy. And the real problem is not the financial collapse itself, but the fact that over decades, the real economy, the capitalist economy, has been stagnating. The growth rates have been falling in the United States and in the entire world capitalist system, and investment has been stagnating and so on. Real wages have been dropping, and this is the crux of the problem. So I want to kind of give you an idea of that. Here's a graph here. This is just an illustrative graph. You see here it's an index, so 1959 equals 100. The red line there is total goods production as a percent of GDP. And that, of course, includes industrial production and other forms of good production. But you see how that, as an index, the goods production is sinking, right? And then you have on the blue line is debt as a percent of GDP, and it's soaring. And so you have these two phenomena: stagnation of the real economy, or stagnation of production, and an explosion of finance. Now, what is the relation between the two? Some people want to say, well, it's this explosion of finance that's the cause of the stagnation of the real economy, but that just isn't the case. It goes the other way. The production has been in a long-term decline and started to decline first, and the financial bubbles, the financialization, the shift in gravity of the economy from production to finance has actually been lifting the economy in various ways. It's been keeping demand up, keeping the economy expanding despite the stagnation underneath. So I want to try to explain to you a little bit of how this works and why it's so important. Maybe the thing to do is to, well, first of all, you can look at this in terms of the growth of debt. This is domestic debt and GDP. And I don't want you to look at all of it particularly. I mean, you can see how fast the total debt is going up in relation to GDP, how much faster debt is going up than incomes. But you'll always hear about government debt. Look at this, the four categories of debt: household, financial firms, non-financial firms, and government. And in trillions of dollars, government is the least important in terms of debt, and the one that's expanding less rapidly. You are always told about government debt, but it's actually the financial debt, household debt, and non-financial debt that's the problem. So if you look at this, there's a chart on private debt as a percentage of GDP, and you can see here the red line, which goes up very fast, is financial debt as a percentage of GDP. From the 50s to the present, look how in the 80s it takes off. Then you have household debt as a percentage of GDP also soars, and finally non-financial business debt. That's non-financial corporations. Their debt has soared, but not as rapidly. And this is the problem. There has been more and more reliance on debt as a form of economic expansion. The household debt went by 2005. Household debt had reached 125% of disposable income. Total household debt had risen from I think in 20 years or so, I have to check that figure, but had risen from about 60%. Yeah, in 1975, debt as a percent of disposable income, consumer debt as a percent of disposable income was at 62%. By 2005, it had reached 125%. So what was expanding the economy to some extent was debt, including household debt. We'll talk about that more in a minute. But if you look at the next chart here, it gives you an idea of what was happening. The blue line is GDP, so it shows this is an index. So with 1970 equals 100, it shows the growth of GDP. But look at the growth of financial profits in relation to the growth in GDP. GDP is national income, right? So that includes all forms of income, wages, profits, etc. The rent, that is reflected in the growth of GDP. That's the growth of national income. But look at the growth of financial profits in relation to that. It's completely off the charts. And even non-financial profits goes way up. It's there's a notion in economics. The Deutsche Bank did an analysis of this in sort of an inside analysis of this in 2000 in July 2008, and they said, look, a principle of mean reversion would say that those financial profits eventually are going to fall down to the line of GDP. They can't keep doing this. So this means that there's going to be a crash in financial profits, that there's going to be a huge devaluation of profits, a destruction of capital, and that's exactly what's happening. Now, so all of this is what you can see is a financial explosion which has lifted the economy, has resulted in a financial implosion where finance, a long-term process of financialization is collapsing, and we're seeing a crisis that's affecting everybody. Now, I want to go back to the real economy. To get to the answers, we have to go to the root of the problem, and the root of the problem lies in the stagnation of the what economists call the real economy. That is the GDP economy, forgetting for a moment about financialization. And you see this is the growth in real GDP of U.S. real GDP, 1930 to 2007. Now you can see in the 1930s, of course, the United States, that was the Great Depression, had a rate of growth, average annual rate of growth of 1.3% in that decade. And then in the 1940s, because of the Second World War, the economy took off. And it grew by 70% in just 6 years. You have this almost about a 5.9% rate of GDP. Then in the 50s and 60s, you have what is called the now called the golden age of post-Second World War capitalism. We're in a peacetime economy, or mostly peacetime economy, because we can't forget the Korean and Vietnam Wars. You had rates of growth of over 4%. And then in the 1970s, stagnation sets in. You have the growth rate keeps on declining. If you look at 2000 to 2007, the growth rate is 2.6%, and that's before the crisis starts, right? That doesn't reflect the problem that we're in now. So the rate of growth is going to sink drastically for the remainder of this decade. So you have a kind of slowing down of the economy. For 30 years they've been telling you, well, we can't pay for this, we can't pay for that, we have to have cuts in school spending, we have to, we can't pay for health care, we can't. Why is this? It's because for 30 years, from the standpoint of the system, we've been in a kind of long-term stagnation crisis, which is getting worse. And what is the root of this? Well, if you look at the next chart, you get remember those charts about profits as a percentage of GDP going up? Well, this gives you from 1950 to 2010 the wage and salary disbursements as a percentage of GDP. And you can see it's going down, down, down. So that what it reflects is the fact that wages and salaries are a steadily declining percentage of national income. And but in the same period, the United States saw consumption rise from well, not in the same period, but if you go back to say, yeah, I guess in the same period, you see consumption rise from something like 60% of GDP to 70% of GDP. How does that happen? How do wage and salaries disbursements fall and consumption goes up? Well, a very large part of it was a result of people working longer hours, more jobs, more people per household working, and also the increase in debt. But the reality is that real wages in the United States, productivity has been going up year after year. You've heard about it. Profits have been soaring. And real wages in the United States have not risen since the 1970s. In fact, the real wage in the United States for non-agricultural workers, private non-agricultural workers, in 2007 was the same as it was in 1967. So we have not seen any rise in real wages over since the late 1960s. And this puts an incredible strain on the economy. The economy is getting more and more unequal. You have a situation in the United States now, if you look at just the income aspects of this, you have 1% of the population. 1% of the population. I want to make sure I get this. Owns more wealth than the bottom 80% of the population, and if you owns twice as much wealth as the bottom 80% of the population. 1% of the population in the 2000s owned over twice the wealth of the bottom 80% of the population. And if you go by just financial wealth, 1% of the population owns over 4 times as much as the bottom 80% of the population. So the wealth is very, very concentrated at the top. Meanwhile, you have these developments in terms of income that are quite extraordinary. Over the years 1950 to 1970, for each additional dollar made by those in the bottom 90% of income earners, those in the top 1/100th of 1% received an additional $162. In contrast, from 1990 to 2002, for each added dollar made by those in the bottom 90%, those in the upper 1/100th of 1%, today about 14,000 households made an additional $18,000. If this were measured simply in terms of, it's absolutely extraordinary the level of concentration that in income that's occurred. Between 1983 and 2001, the top 1% grabbed 28% of the rise in national income, 33% of the total gain in net worth, and 52% of the overall growth in financial worth. All went to the top 1% of income and wealth holders. So you have this extraordinarily unequal structure of income and wealth in the country that's getting more and more unequal all the time. And actually this underlies a lot of the problems within the economy. It promotes an enormous surplus at the top, an enormous economic surplus, enormous profits at the top, and they're not able to find profitable outlets for that surplus. So they're always dealing with the problem of a glut of funds available, of investments seeking surplus. And the reasons they can't find any outlets for investment are complex, but one of the reasons is that the consumption is in some ways is held down or so dependent on consumers whose household debt has been going up and up that the expected profits on any new investment, let's say 5 or 10 years in the future, are very low. It's too risky to invest in new productive capacity under this kind of situation, so they don't. And what they do is they use their surplus to speculate in financial assets under the theory that they can make money that way by speculating in asset prices, and the ballooning of finance will create huge financial profits and capital gains and so on. And this has actually boosted the economy because the growth of assets has created a wealth effect where people the wealthy particularly are seeing we're seeing their asset prices rise, and they took some of the gains and they spent it on consumption. And homeowners saw the values of their houses rise, and they took some of the gains and they cashed them out of their houses and used them to support consumption. And so, but what that meant is the system became more and more leveraged. And what happens if prices start to fall, if things turn the other way, if the expansion stops, then you get a negative wealth effect where everything goes into reverse, where the economy deleverages maybe even faster than it leveraged its way up. So the speed of which it can go down is enormous because everything is based on borrowed dollars, and when the prices start to fall, you have to pay back those borrowed dollars, and you're not facing rising asset prices anymore, as homeowners know, but you're facing falling asset prices. And if the general price level falls, you have to pay your debts. The debt that you're facing is bigger dollars because those dollars are worth more over time rather than worth less. At any rate, what we have is a situation at the real economy level of a kind of overcapacity, a buildup of productive capacity, and because of the demand structure of the economy, they're not able to utilize that capacity. So you see this graph here of, actually this is mislabeled, but it wouldn't make any difference. It's industrial capacity utilization, but it would look the same. And you see this this is a 10-year moving average. You see falling capacity utilization in industry. When capacity utilization goes down like that, business doesn't invest. They don't invest in new productive capacity if they're not able to use their present industrial capacity. It makes it too risky. So this is an indicator that there are problems in terms of demand, problems in terms of investing in expanding the economy, and so investment collapses. And I want to show you one last chart to get at this, and this is here. This is a chart that I devised that shows profits as a share of GDP, a 5-year moving average, as opposed to private non-residential investment as a percentage of GDP, a 5-year moving average. What you have is then looking at the red line, the net investment line. This is basically net investment, but not including the residential sector. It's basically net investment in the area of production. Okay. And you see how net investment in the U.S. economy has been stagnant and declining. It's not going up. In fact, if anything, it's going down. Right? It's slumping, and investment is what expands the economy. It's what produces economic growth. That's the core. When you talk about capital accumulation, that's what capital accumulation is. That's what those with money, capitalists, are supposed to be doing. They're supposed to be investing it in the expansion of productive capacity, new capital formation. Well, you can see new capital formation as a share of GDP is slowly sinking. Well, look at that top line, the blue line. You have profits as a share of GDP rising. So what that shows is that they actually have more economic surplus, more profits as a share of GDP. And those profits, if capitalists are functioning as capitalists in the traditional sense, are supposed to go into investment. That's where those profits are supposed to go. That's what funds investment. And yet they're not. They're going up. The profits are going up, and the investment is going down. So obviously, that surplus has to be used somewhere else. Is going somewhere else. Where is it going? Where has it been going? Well, it's been going into the financial system. Instead of investing in the expansion of productive capacity under these circumstances, and this is really a manifestation of the whole stagnation problem, which is manifested in the stagnation of investment. They're choosing, and it's really kind of a necessity on their part to put their funds into money claims to wealth, the assets, financial assets, and this is what's happening. You can look at it if you just think of this problem of the real economy versus the financial economy. It's not very often explained to you. But I said there are two different pricing structures. John Maynard Keynes explained this in the 1930s, but it's a part of his analysis that was largely overlooked. That there are basically two pricing systems in the modern economy. And one pricing system that you know about is the pricing of income and output. And these are the prices that we deal with in our everyday life when we buy things in stores, and it has to do with production GDP. The other pricing system is the pricing of assets, like the pricing of houses, the pricing of stocks, the pricing of securities, and so on. And that follows completely different principles. In fact, nobody's quite clear about what principle the pricing of assets follows, except that they hope they'll just keep going up and up. And they thought they knew. They thought they would they would keep going up, and that this would keep on lifting the economy, because there's nothing else that's been lifting the economy but these financial bubbles. And Alan Greenspan, in his testimony to Congress just a few days ago, said, well, they'd had these models that had said that it would keep going up, and that it would be okay, and they would be able to keep the economy going based on this increase in finance. But he said they forgot to put in their models anything prior to the last 20 years. So when he said when they put the inputs into their models, they based the inputs entirely on the period of financial euphoria, and they left out the Great Depression and all the periods of economic crisis. He says now that was a mistake. They should have considered the possibility of crisis in the model, put it in there. But if you create a model that only takes data from a period of an expansion, and then what does the model feed out to you? It feeds out to you the answer, as Greenspan just said last week, that only expansion is possible. And he says now that was short-sighted. He said we had great mathematicians, great computer models. These were very smart people, he says in quotes, but they failed to realize that. And so what you have is a situation where the economy, and of course they ignored the whole stagnation problem, and they put it off. But the fundamental problem here is then you need something to lift the capitalist economy. They pretend that the capitalist economy heads towards full employment on its own, that it promotes prosperity on its own, that it needs to be not regulated, that it's self-regulating, that it produces rapid growth on its own. Well, all of this history and all history teaches us that that isn't true. The capitalist economy doesn't grow rapidly on its own. In fact, it tends in the modern period to sink into stagnation. And the only things that really lift it up, are under the current relations of power and the current economic relations. What lifts it up is what? In the great the golden age of Second World War prosperity, of course, there was the automobilization of America and the building of the interstate highway system, which demanded glass, rubber, and steel, and concrete, as well as the automobiles themselves, and so on. There was after the war that consumers had a lot of savings. There was the rebuilding of the European and Japanese economies, and there was the military spending, which continued at a very high level in the post-Second World War period, including the two regional wars, Korea and Vietnam. And all of this military spending, all of these other factors spurred the economy. Eventually, though, the economy started to sink, and the answer became financialization from the 1980s on. And this is really the era of neoliberalism. It was the building of this huge financial superstructure which kept the economy going. Military spending is still there, but it doesn't give us enough of a stimulus, and so on. And they don't really have anything else to stimulate the economy. And of course, this is all has to do with the current structure of power. If you were to have a different structure of power, other possibilities might open up. And one thing we can talk about is, we talk about economics, but the classical name for economics was political economy. They didn't call it economics in the beginning. They called it political economy. And why did they call it political economy? It's because in the classical period, I'm talking about Adam Smith, Thomas Malthus, David Ricardo, and John Stuart Mill, James Mill, who are all possessive individualists, as we say, classical liberal thinkers. They wrote about political economy. In fact, almost all of their books were called political economy, had political economy in the title. And there was also another classical theorist of a socialist vein, Karl Marx, who wrote a critique of political economy. But the notion was that economics was really political economy. And why did they call it that? It's because the fundamental category of economics in the classical conception was the concept of class itself, a concept that doesn't exist in modern neoclassical economics. The concept of class was the basis of their conception of the economy, and all forms of income were returns to classes. For example, profits basically went to the industrial capitalist class, rent to the landlords, wages to the workers, and so on. And they understood the state as part of the whole makeup of the political economy, even though Adam Smith coined the notion of the invisible hand of the market, which was supposed to replace the visible hand of the sovereign. Still, he understood that the state was part of the system in a way that is not understood in economics now. Well, when the capitalist class basically took over the state in the 1830s and 40s from the aristocracy in England and France, and when the working class started to get restive and to threaten the system, the capitalist class stopped talking about political economy. In fact, they threw out the concept of class. They basically gave that concept to a new field called sociology, which got class but wasn't allowed to talk about the economy. And they gave the state to a new field that appeared at the same time called political science, which was allowed to talk about the state but was not allowed to talk about class or the economy. Well, the economics became modeled over individuals making marginal gains, the productivity of individuals, the consumption of individuals on the margin, and so on, and completely removed from all political aspects. It's not that the politics wasn't there, it became invisible because the politics so much was in accord with the system of power that it completely disappeared. Sure, we had an invisible hand. The invisible hand what was invisible was the capitalist class, the hand of the capitalist class that replaced the former visible hand of the sovereign. And that was the reality. So when Secretary Henry Paulson came to Congress on the night of September 18th and said, the whole system, the financial system is going to melt down, give me $700 billion. And Congress said, okay. And then the next day the public found out and they were outraged. And so there was a revolt within the grassroots in the House, led by grassroots Republicans. That is interesting itself, but they did have some working class voters they were appealing to, and they were desperate. And so there was a revolt in the House, and for a moment they turned down the bailout. But it was a great political moment because suddenly we had political economy. Everyone in the country was talking about the fact that somehow the economy related to our politics, to our existence, that we had some determination over it. And normally nobody asks. They had to come to the Congress because the Federal Reserve had basically exhausted its, I won't go into the details of that, but the Federal Reserve's Treasury securities, holdings of Treasury securities had gone way down. So they had the Treasury to go to Congress to get more support and to also get more authority. But they don't normally even ask. Remember, they've committed $5 trillion. You remember them asking about the $700 billion. Do you remember them asking about the other $4 trillion some dollars? No, it's more than that. So when they did come to the public on September 19th everything kind of broke loose, and it's very hard to put it back together again because people suddenly realized, well, there's a political economy. It's their economy. It's something, and once you put politics into it, you realize there's the question: who pays, right? Who's going to pay for this, and actually who makes the gains? And people start looking at it in a different sense. And so, fundamentally, we have to create that that sense of, well, what do we do? Why, Robert Kuttner? There are many people who now think that that if Obama gets in, they can have a New Deal. Robert Kuttner, in his Obama's option, is proposing a $700 billion civilian government spending to lift the economy. I don't think they can do it they can't do it with this structure of power. It would require a mass movement on the level of the late 1930s, and even in the late 1930s they weren't able to do anything like that. Then what got the U.S. economy out of the Great Depression was not the New Deal, but the Second World War. At the high point of the New Deal, civilian government spending in 1939 was 13.3% of GDP. Now it's 14% of GDP and has been 14% of GDP for about 40 years, hardly varying at all. And the political forces preventing any kind of government intrusion into the economy are enormous. It's not something that can happen from the top or easily. It actually requires a mass labor movement, a mass social movement from below, where people are talking about political economy, the political economy that's ours, and adopt a critical perspective. And I think that will happen in the United States, but even before it happens in the United States, it might start happening in the rest of the world. The Latin Americans have already thrown out neoliberalism, and in many of the states, and other states are throwing it out even more. They're in revolt against capitalism as we know it. And I think more and more of the world will be, and ultimately in the great bastion of conservatism in the world, the United States, this may happen too. There are all sorts of things we can do if we say it's our political economy. For one thing, we spent $1 trillion in the United States in 2007 on the military, which used to seem like a big number. But we could take a lot of that, or all of it, and put it into other things. You could solve all the basic you could really not solve, but you could deal with many of the basic problems in the country if you could get access to that. Education, health, housing, and so on. But that requires a class movement, really what would be seen as a revolutionary movement to make it happen. And so that's where we're at. There's no real way out of this for the system. We're faced with long-term stagnation, and the whole nature of the politics in which we've grown up is likely to change under these circumstances. It's a grim reality, but it's something that we have to face. And I guess you know that your pension funds are disappearing, those of you who have them, that health care costs are going to go up, not down, that the plan is to cut back everywhere. Obama does not represent anything progressive in this area at this point in time, and we can't hope magically anything to happen from the new administration. The general approach to these things is to have massive cutbacks. That's the natural approach. Look what's happening to Iceland, right? The entire economy melted down, and they got rescued from outside, but those who rescued them are saying, yeah, but we're taking all the pension funds, and not, which will no longer be pension funds, they will be capital for those who've stolen away with them. And a lot of stuff like that is going to happen. Unemployment is going to rise massively right now. And it's a question of whether we organize, whether we understand, those of us who have a kind of progressive vision, whether we understand this as a political economy, we understand that this is decisions are going to be made on the allocation of wealth and income, and maybe eventually people will come to understand, and maybe more quickly than we ever suspected, that this is a dangerous roller coaster that we have to get off, that we have to create a qualitatively new society that's oriented to the needs of people and reflects a real political economic democracy. The classic term for this has been socialism. And those in power always call it socialism. They decry it as socialism. I think, though, that it's what people need and what we have to fight for. We have to fight for a society where the mass of the people control the results of their production, and otherwise we won't be able to continue in anything like the way that we've come to expect. There's also, and this is my last point, this is the economic crisis. You think that's bad? You have to learn about the environmental crisis, which is what I spend a lot of time on. We're actually bringing down the whole planet with this system, but that's another story. But it might give you an added reason for change, because the annihilation of all life on the planet is also a negative factor, in my view.